The financial markets are like a vast ocean capable of both serenity and storms. Recently we have witnessed the winds of change creating choppy waters for investors. The S&P 500, a key indicator of U.S. stock market performance, has experienced significant fluctuations. These swings are a clear sign of heightened volatility, indicating uncertainty among investors. Understanding market volatility is crucial for investors. Volatility reflects the degree of price fluctuations in a market. High volatility means larger and more frequent price swings, both up and down. While volatility can create opportunities, it also brings increased risk. It is essential to remember that market fluctuations are a natural part of the investment landscape. Markets are constantly reacting to new information, economic data, and geopolitical events. The recent volatility is a reminder that market conditions can change swiftly, underscoring the importance of a well-defined investment strategy. Navigating these turbulent waters requires a steady hand and a clear understanding of the forces at play. By delving into the factors driving this volatility, we can better prepare for the journey ahead. Beneath the surface of the volatile stock market lies a potentially more significant concern: the Treasury market. The Treasury market is the bedrock of the global financial system, and tremors within this market can have far-reaching consequences. One of the most pressing issues is the risk of forced liquidations. Forced liquidations occur when investors, often heavily leveraged, are forced to sell assets to meet margin calls. When a large number of investors are forced to sell simultaneously, it can create a liquidity vacuum. Liquidity refers to the ease with which an asset can be bought or sold without causing significant price changes. A lack of liquidity in the Treasury market is particularly alarming. Treasury bonds are considered one of the safest and most liquid assets globally. If liquidity dries up in this market, it can lead to a domino effect, impacting other asset classes and potentially freezing up the entire financial system. The current situation bears similarities to the March 2020 crisis, where a sudden dash for cash led to a liquidity crunch in the Treasury market. This event required significant intervention from the Federal Reserve to stabilize the financial system. The current risks in the Treasury market underscore the importance of vigilance and proactive risk management. Adding to the complexity of the current market environment is the basis trade, a strategy employed by sophisticated investors, including hedge funds. While seemingly obscure, the basis trade can have a significant impact on market liquidity, particularly in the Treasury market. In simple terms, the basis trade involves exploiting price discrepancies between Treasury bonds and Treasury futures contracts. Hedge funds often leverage their positions significantly, amplifying their potential gains and losses. When the gap between bond and futures prices widens beyond a certain point, it triggers margin calls, forcing hedge funds to unwind their positions. This unwinding often involves selling Treasury bonds, putting downward pressure on bond prices and further widening the basis. This creates a vicious cycle, exacerbating liquidity concerns in the Treasury market. The basis trade is just one example of how interconnectedness and leverage within the financial system can amplify market moves. The current pressure on the basis trade, driven by rising interest rates and declining bond prices, highlights the fragility of market liquidity. Understanding these complex dynamics is crucial for investors to navigate the current environment. In these turbulent times, it's more important than ever for investors to remain calm and focus on what they can control. While the current market volatility may seem daunting, history teaches us that market downturns are a natural part of the cycle. One of the most effective ways to navigate uncertainty is to adopt a defensive investment strategy. This may involve increasing cash positions, reducing leverage, and diversifying across different asset classes. Cash can provide liquidity and flexibility, while diversification helps mitigate risk by spreading investments across various assets. Monitoring key market indicators is also essential. Treasury yields, the VIX volatility index, and the US dollar are all barometers of market sentiment and can provide valuable insights into investor behavior. By staying informed and adapting to changing market conditions, investors can weather the storm and position themselves for long-term success. Remember, market downturns can also present opportunities. As prices fall, undervalued assets may emerge, creating attractive buying opportunities for discerning investors. It's crucial to approach these opportunities with a long-term perspective and a disciplined investment strategy. The current market environment requires vigilance, adaptability, and a deep understanding of the forces at play. By staying informed, managing risk effectively, and maintaining a long-term perspective, investors can navigate the challenges and capitalize on the opportunities that lie ahead.